Should you transfer property into a limited company? Everyone talks about buying property through a limited company, and for new purchases it can make a lot of sense. But what if you already own property personally and want to transfer it into a company? That's where things get messy, because if you get it wrong, you could trigger tax bills so big they wipe out the benefits completely. In this video, I'm breaking down when transferring property into a limited company actually works, when it doesn't, and how to structure it safely. If you're serious about building wealth without falling into HMRC's traps, hit subscribe, because we break down strategies like this every single week, and you do not want to miss what's coming in the next budget either. Let's start with the big question: why people even want to move their property into a company in the first place. On paper, it looks like a no-brainer. You pay corporation tax at 25% instead of 40 or 45% income tax personally. You can keep the profits inside the company to reinvest, buying your next property without triggering personal tax. You separate business and personal risk. If something goes wrong with the tenancy or the mortgage, the company takes the hit, not you. And long term, it opens the door to far more flexible inheritance and wealth planning, because shares are easier to restructure than bricks. It all sounds perfect, and that's why so many landlords rush to do it. But here's the problem. When you already own property personally, your company isn't you, it's a completely separate legal person. Transferring a property from yourself into the company isn't just paperwork, it's a sale. And HMRC treats it exactly like that, even if you never receive a penny. And that's where most people walk straight into a tax trap. The moment you transfer property from your own name into a limited company, two major taxes hit you instantly. Capital gains tax. Bought at 200,000, now worth 300,000, is a 100 grand gain. HMRC taxes the gain at 18% for the basic rate and 24% for the higher rate. So for higher tax rate payers, that's 24,000 of CGT just to move the property on paper. Stamp duty. Because your company is buying the property from you at market value, stamp duty is due on the full 300k, with the mandatory 3% surcharge for company purchases. Stamp duty is roughly £11,500 to £12,000 on a 300k property. So the total tax hit is 36 grand before you've even touched a pen or printed limited on a letterhead. There's no mates rates, no discount, because it's your own company. HMRC uses market value every single time. So does that mean you should never transfer property into a company? Not at all. There are situations where it works, but they're very, very narrow. The biggest one is Incorporation Relief under Section 162. It allows you to defer the capital gains tax if and only if you're running a genuine property business, not just collecting rent. HMRC looks for several properties: regular active management, maintenance, inspections, tenant contact, advertising, admin, accounting, like real weekly involvement, evidence of systems and operations. If you can demonstrate that your rentals are a business, you can incorporate without paying CGT today. If you get it wrong, HMRC treats you as a passive investor and the CGT bill lands instantly. Stamp duty, the partnership route. Even if you qualify for Incorporation Relief, you still have stamp duty to deal with. A company buying property normally pays stamp duty on the full market value, always. But there is one legal route that can eliminate it. A genuine, long-standing partnership prior to incorporation under the partnership rules. Incorporating a genuine partnership can avoid stamp duty because you're simply changing the wrapper around the same business. But the partnership must be real. You need to evidence shared rental income, a history of joint management, ideally a joint bank account, a pattern of activity over years, not something created last Thursday to dodge the tax. A real partnership, stamp duty potentially is avoided. Fake partnership in HMRC will nail you to the wall. Let's run the numbers so you can actually see the difference. Portfolio 2, properties worth 300k, bought for 200k, total gain is 200k. Without relief, the CGT on 200k is 24% at 48 grand. Stamp duty on 600k with a surcharge is 23 grand. The total upfront tax is 71 grand just for transferring them to yourself through a company. Now with Incorporation Relief and genuine partnership, The CGT is deferred, it's not paid today. Stamp duty is eliminated under the partnership rules. Future profits are taxed at 25% CT, not 40 to 45% income tax. The same portfolio, completely different outcomes. Now here's the truth nobody tells landlords. For most people, the best move isn't to rush and shove everything into a company. The smart play is to keep your current properties where they are. Use a company or SPV for new purchases. Build a real property business structure over time. Create the evidence HMRC requires before you try to incorporate. Then later, once you genuinely meet the criteria, you can move your portfolio into a company far more safely. The difference between saving tens of thousands and losing tens of thousands comes down to timing and structure. So start with our tax game plan, it's linked below. If you want a deeper strategy on group setups, trusts, inheritance planning and multi-entity structures, join the YouTube membership, I think that's above. And if you want it all handled for you, the compliance, the structuring, the planning, the reporting, you can book a call through our website at tax4pros.co.uk. We'll walk you through the cleanest, safest way to build your property structure based on your numbers. Hit subscribe because only around 14% of you actually are, and join the community of directors building smarter, more tax efficient businesses. I'm Sarah from Tax4Pros, helping business owners build wealth, not just businesses.